everyone. My name is Marion Fourcade, and I am the director of UC Berkeley's Social Science Matrix. I am so delighted to welcome you to today's panel on cryptography and the future of money, part of our Matrix on Point series. This event is co-organized with the Clausen Center for International Business and Policy, and I am grateful to Pierre-Olivier Gourinchas, director of the Clausen Center, for the part he played in putting it together with us. The emergence of cryptocurrencies and digital payment systems poses a number of fundamental questions to the social sciences. What, after all, is money, and who should be allowed to issue it? How do monetary authorities look at the rise of cryptocurrencies? And what is the structure of cryptocurrency markets? Today's event is also the first of two we are organizing on the future of money. The second event on this topic on April 14th will deal with the intersection of mobile money and social media. Now, before I turn to introductions, let me tell you about a few other events that we have coming up soon. On March 7th, we have an Author Meets Critics event with Professor Martha Wilford on her book, Pre-Colonial Legacies in Post-Colonial Politics, Representation and Redistribution in Decentralized West Africa. On April 4th, we will have a panel on the social and economic impacts of fire, and that is part of our California Spotlight series. And as I mentioned, we will have our second Future of Money panel on April 14. And you can find many more on our website. You can sign up for the Matrix newsletter or follow us on social media. And now it is my great pleasure to introduce our moderator today. Barry Eichengreen is George C. Pardee and Helen N. Pardee Chair and Distinguished Professor of Economics and Professor of Political Science at UC Berkeley, where he has taught since 1987. He is a research associate of the National Bureau of Economic Research and a research fellow at the Center for Economic Policy Research. In 1997 to 98, he was Senior Policy Advisor at the International Monetary Fund. He is a fellow of the American Academy of Arts and Sciences. I counted 25 authored books and almost as many edited volumes. So I'll just mention the last two most recent books. One is In Defense of Public Debt, which was published, which is co-authored and was published in 2021. And in 2018, The Populist Temptation, Economic Grievance and Political Reaction in the Modern Era. So without further ado, thank you all for being here. Thank you so much to the panelists for what promises to be a wonderful event. And I turn it over to Barry.
And thank you, Marianne and Pierre-Olivier, for co-organizing a meeting on this important topic, cryptocurrency and the future of money. So that title covers a lot of ground. It encompasses a lot of sins. There are different kinds of cryptocurrency, from plain vanilla cryptos like Bitcoin to stablecoins to central bank digital currencies. Under this heading, one might want to consider digital payment systems, which run on public blockchains or private blockchains or no blockchain at all. There is decentralized finance, which is all the rage given Web 3.0, and there's much more. Jay Powell testified about this topic this morning. There's been interesting behavior in the Bitcoin sphere in the last couple of days in response to the imposition of Russian sanctions. So I think we have lots to talk about, and in charge of our talk will be our three co-authors, Marcus Brunnermeier, Professor of Economics and Director of the Bentheim Center for Finance at Princeton. Marcus has done a lot of important work on international financial markets. He works on the frontier between finance and macroeconomics, on monetary stability, digital money, a variety of related topics. His most recent book, The Resilient Economy, was shortlisted among the best books in economics by the Financial Times. He has co-authored with Jean-Pierre Landau, a report for the European Parliament on the digital euro. And among his innovations is very popular web-based platform, Marcus Academy, to which Sergey Guriev is speaking, I think, about the Russian economy tomorrow. So Marcus, welcome to Berry Academy. Stefan Eich is assistant professor of government at Georgetown. Given our names, I feel like we're both descended from the same family tree. So that's a joke for the German speakers on the call. I think actually we're both descendant from the same intellectual tree, Yale University. Stefan's research is in political theory, intellectual history, the history of political thought, theory of money, and his forthcoming book is entitled The Currency of Politics, The Political Theory of Money, from Aristotle to Keynes, forthcoming through Princeton, which covers the relevant debates about money as a political institution stretching back millennia. Our third panelist is Christine Parler, who is the Coleman Chair of Finance and Accounting at the Haas School of Business here at Berkeley. Most of Christine's work is in institutional complex areas. I think that's kind of an understatement. She works on payments, market microstructure, how those aspects of payments and finance impact on the banking system in particular, and her current work is specifically on payments and bank balance sheets. Christina's been on the NASDAQ Economic Advisory Board and is on the steering committee for the new special study of securities markets. So I will now turn things over to Marcus, with the understanding that Marcus and then Stefan and then Christine will each speak for 15 minutes, after which we'll open it up. Marcus.
Thanks a lot, Barry, and thanks to Marian also for organizing it. It's a pleasure to be part of it, and an honor as well. So I will talk about a little bit about the report Jean-Pierre Landau and I wrote for the European Parliament, and about the future of money and the digital euro in particular. So there are new technologies and there's new forms of money appearing, and I would like to outline 4 trends. I would like to start with 4 trends. One is that cash will be marginalized. So it's less important to have cash. We live much more in a virtual world. So payments which are not in form of cash, hardcore cash, is more and more important. The second trend is the big tech trend. So we have now ways to explore data much better than we had in previous decades. So we have big data, we have artificial intelligence, deep learning, and so forth. And this allows us to extract information which we couldn't extract earlier on. So payment data becomes much more important. And there's also a bundling going between money and credit with retail platforms. So this bundling, there are synergies effects across money and credit, which we typically have in the banking, already in the banking literature, but there will be with retail platforms on top of it. And recent work I've shown how the synergies are playing out. And then, as Barry mentioned, then there's a whole cryptocurrency aspect to it. So that's new crypto technology, which allows us to have new forms of currencies and blockchain technology, starting with a Bitcoin. And of course, the most recent developments are stable coins, which come with their own financial instability issues. The fourth trend I would call is Industry 4.0. There will be an explosion of programmable payments. So in the future, it will be the case that there will be supply chains, and the supply chains will be managed on blockchain. So whenever it is a little widget is moving from one place to another place, instead of paying end of the month with all the widgets which move, we pay for each widget separately. So there will be way more payments, and the payments will be triggered whenever the sensor of this little widget touches some other sensor, and there will be automatic payments. So there will be a huge amount of payments, and for that, a huge explosion of payments, there will be new forms of digital money. And there's a potential that this will be closed monetary systems. So there might be the automobile industry will have its own tokens. There will be a blockchain for the widgets or the parts of the cars moving, and there will also be a parallel blockchain on the payments, and they will have their own tokens per industry. And the question is, will there be some fragmentation of all these payment systems for each industry, a separate payment system? And that always led to some rationale for CBDC. What's the role of public money if we pay with these private tokens? Well, why do we need still the public money? How important is the public money? And what the report in particular emphasizes, what's the role of the uniformity of money? So typically we have many issuers, many people, many banks issue demand deposits, but it's always one money. It's a dollar, it's a euro, it's a yen. It's always the same money. So there's an achievement which occurred through central banks in the last 100 years that we actually have uniformity of money, as we have many uniformities of other measures, you know, how we measure the length or the weight of something. Now, there were 3 recent reports coming out just last month or in January. There was the Federal Reserve report, which, you know, was more non-committal and really focused much more on stablecoin regulation. There was an earlier presidential working group studying that. Then there was the House of Lords report, and the title says it all. There was much more skeptical that, you know, this is actually something really new, CBDC, a solution in search of a problem. And the focus was much more saying there will be innovations in payments. What our report is, which we wrote for the European Parliament on the digital euro, is much more, we think it's not only payments, it's actually, it changes the nature of money itself as well. So there will be a change in the nature of money. And that's why, you know, we have to fundamentally come back to traditional thinking. And that's where Barry comes into place and other come in place, and also Stefan, looking back in history, because we went through many of these fragmented arrangements beforehand, and we can learn a lot from historical arrangements by doing so. But essentially, the main message of our report is that uniformity of money you can't take for a given. It might change quite significantly. So how is money affected? As I mentioned, it's more than just simple payment. It's also a change in nature of money. There will be different forms of money. I mentioned already each supply chain, each industry might have its own token. There are programmable money, which is in itself an oxymoron. So because money you can use anywhere, but you know, if you go to Hangzhou in China, the way they pay the stimulus packages, they were paying with some digital coupons, which are expiring. So you can do stimulus packages much more dramatic, saying if you don't spend it, your money expires. Or you can program it in many, many different ways. Then there's a whole debate, and we go in the report, between programmable money and programmable wallets. And there are many different aspects to consider. But you can see there's a danger of segmentation, that it will not be uniform. A token which expires in a month is different from a token which does not expire. So to keep the uniformity of the system will be quite a challenge. Now, the question is, can we live in a system in an abstract way? Can we live in a system where we don't have any public money in the hands of the citizens? So there will be reserves held by the banks, but all the money private citizens are holding is actually given by private entities like banks or big tech companies, fintech companies, and so forth. Is this something viable, or is it really necessary that the central banks have a direct connection to the citizens as well through convertibility? There's an anchor there, and do we need this anchor, or do we don't need this anchor? And this is, fundamentally, you can ask yourself, that's affecting the nature of money. The other thing which really makes a big difference is that there will be more competition across different forms of money. There will be, in the first form, there will be more product differentiation. Some forms of money will grant more privacy, give you a lower interest rate. Other forms of money will grant you less privacy, but give you a higher interest rate, for example. There will be way more competition, and you might view in a Hayekian way that's actually good in order to keep inflation in check, because you have some currency competition. You have currency competition across private players, big tech companies, and the central bank. And you will also have internationally more competition. The currency substitution will become much more dramatic. That squeezes the room for monetary policy space and other things. So that has a huge dramatic implications for the international monetary system as well. So what's about this monetary sovereignty? So with Harold James and Joe Bellandovi outlined in an earlier paper, what is monetary sovereignty? And the biggest element of monetary sovereignty is essentially that you can manage the business cycle. So for this, you have to control the unit of account role of money. It's not really a store of value or the medium of exchange role. You really want to make sure that that contracts, and most contracts are written in your currency. It's also, you can see how prices stick in your currency. That's true if you're a New Keynesian flavor, you think prices are sticky in your currency. If you're more a financial friction guy, you think, oh, it's what really matters in what currency is your debt denominated, and that makes a huge difference. And then, of course, seigniorage. You may get some seigniorage from money creation. That's a part of monetary sovereignty. But what's really also important, I would say this is way more important. Seigniorage is okay, it's nice to have, but to be able to stimulate or slow down the economy, depending which part of the cycle you are, is way more important. The other thing that is important is to be able to bail out certain banks or institutions by being a lender of last resort. By connecting it to a taxing power, having some fiscal space, that actually is also part of monetary sovereignty. And then you have the power to exclude from a monetary system. And we see it playing out now on international scale with Russia being excluded. That's a part of very powerful monetary sovereignty element. If we all pay in Libra, which will not happen, or Diem, then of course this power is going to some private company rather than sitting with some sovereign itself, some democracy. Now the current system is very much a mixture between public and private. It's a public-private partnership. It's a two-tier system. So we have the government and we have the banks. The government has the outside money, it controls the unit of account, but the private banks, they issue inside money. And in certain times, when they're in a banking crisis, then this link breaks, then the outside money, inside money is not a perfect substitute anymore. But when you ask yourself, do you want to have a public money or private money? There are two polar schools, and we have a box in the report about that. So on the one hand, you have the sovereign money school, or this Vollgeld, where there was a referendum in Switzerland a few years back, arguing that everything should be in the public hands. There should be not so much influence of private banks in creating money, and why should the private banks get all this benefit from being able to create money? That's one extreme. On the other extreme, you have the Hayekian school, who are the libertarian movement, where the crypto movement comes in, saying, okay, we'd like to have everything in private hands. We'd like to have a lot of competition, not so much influence of the government. Governments inflate things away. Once there's competition, it controls the governments how much they can do. And the question is, can we live in a world without a public monetary anchor? Can we actually, by playing with regulation, deposit insurance, and lender of last resort, having a bundle of that, can have stable coins and bank accounts, and actually the citizens don't have any access anymore to the central bank directly. But we just make sure there's a uniformity of money out there in form of deposits or stable coins, but we regulate everything such that there's a uniform unit of account there. And is this sufficient or not? Or do we need CBDC, Central Bank Digital Currency, where the central bank tries to go to the public citizen, and through the convertibility into CBDC, you link it onto the public money or not? That's a big question. That's an open question, we outline in the box, and there's more research needs to be done. And that's the key question, essentially. Now, there's another element to it, which is all dealing with banks or financial intermediaries. And we argue the biggest threat for financial intermediaries is actually coming from fintech rather than from CBDC. And then you have to ask yourself, the banks, they get a lot of benefit from being able to create this money. Where does this benefit come from? And is it justified from a social perspective? And so I wrote a little piece on this. What are the different rationales for justifying subsidizing the banks through money creation? And one channel is essentially you subsidize bank, you grant the market power on the deposit taking channel, on the deposit side, so they can actually issue deposits at the low interest rate, way below the market interest rate, and get some cheap funding. And you do that in order to give the bank some franchise value. This way, the banker wants to keep and maintain the bank. He doesn't want to gamble it away, because if he goes bankrupt, he loses the franchise value. This way, you control the risk-taking of the banker in a way much better than you could control with financial regulation. So that's one reason why you would like to subsidize banks. Another reason you might want to subsidize the banks is like you want to give them a carrot to stay within the regulatory parameter. So being subject to regulation, is a stick, and it's not pleasant. And it always moves out to the shadow banking by giving them some carrot to some benefit from being part of the regulatory framework. It gives them this market power. And it might also be the case that you might overcome other financial frictions. You want to endow the banks with some net worth, this way that you can overcome some other financial frictions as well. The big question is, if you want to subsidize the banks, why do you do it through seigniorage, through giving them essentially a freedom to some market power in the deposit market? You can also just give them some money some other way. And a third way, another rationale is to do that. There's some bundling of lending and deposit taking. And that's in particular, this goes back to Anil Kashyap, Jeremy Stein, and others, and Monica Piazzesi and Martin Schneider have some reason to work on that. The outflow of credit lines and deposit taking, there's some correlation. So you want the credit lines on the asset side of the bank's balance sheet and deposit on the liability side of the bank's balance sheet. You want to have this done by the same entity because there's some synergies. And if now suddenly CBDC comes in and becomes very competitive on the deposit side, you kill off the synergies, you take this away from the banks, and the synergies cannot really work out anymore. Another big element is that there are runs, and because CBDC provide another safe haven. And the argument here is that it's actually, we argue that actually it's not really a major concern. It's actually better if people run into some bank, it's better to run in the central bank because the central bank can generally funds back. And if there's a run on the whole system, it's also better if people run in the central bank rather than abroad, because you can actually channel it back and stabilize the banking system again. So I noticed I prepared way too many slides and I'm running out of time. So let me stop here and then probably we can come back to some other points I prepared at the later point in time.
Indeed. Thank you, Marcus. Lots to chew on. Let me remind people to put questions in the Q&A and we'll get to them in a few minutes. Next, we turn to Stefan Eich. Stefan, please.
Okay, so let me first of all join Marcus in thanking everyone for attending, thanking Marion for organizing this, for the invitation, and thank you to my co-panelists for this great session. So what I want to do in the few minutes that I have is really kind of take a few steps back and place this whole debate about crypto that Marcus has outlined so neatly in a broader historical but also political frame. Okay, so in order to make sense of some of these developments, I want to start maybe with the framing that is familiar from the self-presentation that blockchain and crypto projects out into the world, and that consists of usually four interrelated claims. The first one being that cryptocurrencies are technological innovation. There's something interesting going on about cryptography. Secondly, that what marks this technological innovation is its decentralized structure. Right? There's something about decentralization in there. And due to that formal lack of a formal central governance structure, crypto is sometimes presented as somehow beyond politics, kind of out of reach of the kind of messy world of politics. And finally, implicit in that is the idea that somehow this technological advance constitutes a kind of rupture with the past and gives us, as the title of the panel also gestures towards the future of money. Okay. Now, I don't know whether this is controversial anymore. I hope not in some way, but I think it's worth repeating that almost every single one of these claims, every single aspect of this picture is actually quite misleading, if not even straightforwardly false. I'm not going to focus on the detail of this, but I want to just maybe emphasize the last two, and that's what I'm going to be talking about today. So rather than being beyond politics, what actually is the politics that is underlying this shift towards crypto? Rather than being cut off from the past, what actually is the relationship of crypto to the past? And what I want to suggest is that the emergence of crypto is actually better seen as just one particular move in a struggle over the political status of money, some of what Marcus mentioned as the kind of struggle over public money that we've witnessed in particular after the end of the Bretton Woods system. right? So rather than simply giving us a future cut off from the past, I think actually, at least when it comes to the level of kind of debates about the status of money, actually, when we take a hard look at crypto, what we see is a reflection of the 1970s by way of the global financial crisis. So in order to get deeper into this, let me kind of shift towards a more conceptual overview of where I'm going. Because going beyond this misleading self-description of crypto, I think we quickly run into a number of fascinating but very tricky political questions. And that's where I really want to focus today, by kind of turning towards the idea of crypto politics. And crypto politics in two different senses, in the sense of both something being hidden and crypto in the sense of being encrypted. And I'm going to spell this out along these two dimensions by pointing first towards a hidden politics of monetary de-democratization, and secondly, and more cryptically, an encrypted politics of the so-called democratization of finance. So let me spell these out and take them in a historical context. The first dimension of crypto politics takes us back to the moment in which crypto emerged, which is mere weeks after the collapse of Lehman Brothers in the fall of 2008. And I think that is not coincidental. The fact that the original Bitcoin white paper appears in the context of, well, the failure of Lehman Brothers and subsequently a kind of wave of bailouts to prevent further implosions across the financial sector. It's well known that the Bitcoin Genesis block includes an explicit reference to the British banking bailouts from January 2009. Right? The Times, the 3rd of January 2009, Chancellor on brink of second bailout for banks. I think Adam Tooze has recently compared this to one of these scenes in a hostage video when the hostage is forced to hold up a newspaper of the day. And I think what's telling here is that the newspaper headline actually is very clearly, consciously chosen. Here is the front page of the Times of London from that day. There could have been a lot of other options, eating out from £5 to something about the best spas on the planet. But instead, the Chancellor on the brink of second bailout for banks is the one that was chosen. And embedded in this is, I think, a kind of first hint at the politics. Now, that headline has by now taken on a kind of in-joke dimension in Bitcoin circles. You can buy T-shirts with it, or perhaps more appropriately, you can buy hoodies with the Genesis block code and that headline emblazoned on it. And once we place this alongside the Bitcoin white paper, I think we can begin to pin down the crypto politics dimension of crypto that I gestured towards. Because what happened during the financial crisis, as the world's central bank and treasury stepped into the breach, undertaking these enormous rescue actions, is that the myth of neutral money, money simply beyond politics, rapidly unraveled. Seemingly depoliticized monetary systems that were supposed to be, based on rules and discipline, were revealed to be hinging on the discretion of central bankers. And in particular, the recognition that central bankers could essentially create money with the click of a proverbial button, I think really provoked a kind of cognitive shock in the broader public, who are not familiar with the kind of ins and outs of the monetary system. And it's in this context that Bitcoin appears as an attempt to remove money from this state-bank nexus, this kind of private-public partnership that Marcus referred to. An attempt, in other words, to truly privatize money, right, by removing the need for a trusted third party. And so that's the promise of a new form of money without trust. And you see here just one paragraph from the Bitcoin white paper. Closely connected to that removal of trust is also the removal of discretion. And so embedded in Bitcoin's deflationary algorithm is a project of artificial scarcity, and a project that intentionally abolishes discretion. No more central bankers who can add zeros by the stroke of a key, but also no more bankers who can create dubious loans and thereby create money. Now, this has some obvious resonances with the idea of Bitcoin as a kind of digital gold, right? And the first wave of kind of Bitcoin books, really picked up on that. But it also, as Marcus also already hinted at, really contains echoes of earlier attempts to privatize money in the context of the 1970s, and especially of Hayek's call for the denationalization of money. Now, there is a twist, of course, and that is that for Hayek, the goal was to wrest money from the state in order to give it to banks. But in the financial crisis, I think what was revealed was precisely the kind of public-private partnership model. The fact that banks are not simply private businesses, but that they are in fact tethered to the state and its central bank. And so crypto aspired to wrest money not just from the state, but also from banks. The more fundamental point behind this is that the financial crisis essentially made the contested political status of money once more visible. And that invited, on the one hand, attempts to privatize money, like the Hayekian call, to remove it from the state, to subject it to competition, and so on. But the crisis also produced calls for a repoliticization of monetary policy, the need for global monetary reform. And I think we really have to go back all the way to the 70s to find anything remotely resembling this kind of ideological struggle, this kind of debate. Because it was in the wake of the Bretton Woods collapse, in the context of high inflation, that the political status of money, the global monetary system, became such a hot political topic before. And crucially, not just domestically, but especially so internationally, in a new world of floating exchange rates and capital mobility. So there were Hayek's calls for the denationalization of money, but there were also calls from the global south for a more democratic global monetary system. Like my favorite initiative here is the Arusha initiative, proposing a kind of monetary NIEO in the late 70s, early 1980s, a new Bretton Woods, but now with all the recently decolonized countries actually sitting at the table. And I find placing crypto within these struggles over the political status of money actually quite clarifying, because it allows us to see the kind of crypto politics that lurks behind the removal of money from questions of trust. So we shouldn't take this seeming call for depoliticization at face value, but instead understand it as based itself on a particular kind of politics of de-democratization. Okay. Now, the interesting thing is that in many ways, crypto's original challenge to the public nature of money has turned out to be a dead end, at least when we're talking about the kind of classic cryptocurrencies, but certainly Bitcoin. They simply turned out to be too volatile, far too volatile to effectively serve as a unit of account. There's a deep irony here, of course, because the idea of Bitcoin as future money precisely fell victim to its own success as a speculative asset. So today, even many crypto advocates have largely ditched the idea that crypto is straightforwardly future money. Instead, crypto is being pitched as a unique kind of asset. And I think you can see that most clearly in the case of NFTs. But the question continues to linger, and that's where it connects back to Marcus's talk, in the realm of stablecoins, and in particular, central bank digital currencies. Right? That's where the struggle between the political status of money, the privatization versus democratization, continues to rage. Public money is a form of infrastructure, and just I'm actually quoting the European Parliament report that Marcus co-authored. The main rationale for developing a digital euro would be to preserve the role of public money in a digital world. The twist I would add to this, the footnote I would add to this, is to say that this is not just an issue of financial plumbing, stability, but also a fundamental question of political theory. Right? There's a political theory element to the monetary sovereignty side. Privatization is, from that perspective, not just potentially destabilizing, but is itself also a form of de-democratization. Right? Money not just as a form of public infrastructure, but as something that kind of forms part of our democratic understanding, of our democratic imagination. Now, with that said, let me turn to the second dimension of crypto politics. And in the little time that I've left, I just want to very briefly at least mention this dimension, because I think it's kind of new. Because while the struggle for the political status of money continues with regard to stable coins and CBDCs, much of crypto has kind of moved on from the idea and is instead straightforwardly concerned with crypto as a form of speculative asset, and openly embracing this idea of crypto as an asset, a ticket to quick wealth in a world in which net wealth is increasingly a privilege of the few. And something really interesting and frankly bizarre has happened here ideologically, because crypto as an asset has adopted our language of democracy. So as a speculative asset, it now casts itself under the mantle of the democratization of finance. And to kind of pick the slogan that Robin Hood popularized, but it's kind of seeped out into the crypto world more broadly. Moreover, even I think some of the best economic and financial interpreters of crypto are sometimes seduced by this language, by this idea that the accessibility of highly speculative investments is something we should describe as democratization. Right? So I'm just mentioned this excellent book by Iswar Prasad, who actually hedges his prediction and cautions against it, but he nonetheless adopts the language of democratizing finance for anything that makes financial services, including speculative crypto investments, more widely available. And I think the question to ask here is, what is the conception of democracy that's doing any work here? There's no theory of democracy provided. There's usually no engagement with democratic theory. It's a slogan, but it's a very suggestive slogan. And we need to ask, what is implied by this slogan? It's a very peculiar idea of democracy as the ability to access something. But the equality side of democracy, the idea of democracy as one person, one vote, really kind of disappears at that point. Instead, we encounter again an echo of another neoliberal association of democracy, namely the idea of $1, one vote, or rather in the crypto world, one token, one vote. Okay, so that's the kind of reference to the old Van Mises line that every penny gives a right to vote. We've come full circle here in these debates about money and democracy. Let me end here, and I just want to pose a question that I frankly don't know the answer to, namely whether we should nonetheless count this as a kind of ideological victory, that we've now at least managed to discuss what we mean by democracy, that the debate is about democracy. Or, kind of more skeptically, is this actually a kind of confused misinformation campaign whose fog makes it in the end harder to see what's really going on, right? So is there any hope that we can decrypt democracy in the realm of money and finance? That's the question I'm going to pose, and I'm going to end here. Thank you so much.
Thank you, Stefan. Thought-provoking indeed. So Christine, over to you. And before you start, let me remind people about the Q&A. Once again, put your questions there, or you will have to hear half an hour of mine.
Thank you, Stefan and Marcus and Barry. I'm going to apologize. So we went from Marcus's stunning background presentation to Stefan's very elegant slides. And with me, I've just got a piece of paper that I'm holding in front of me. It's very old school. I thought I'd just preface my comments by explaining to you a little bit about how I view the world, and in particular, how I view the world is very much shaped by my research. So first of all, I'm interested in markets and how to design markets, and how the ability to trade affects real outcomes, just as a sort of a general topic. Second, I'm interested in banks and banking, and in particular, how banking's role in the payment systems affects the stability of banks and also affects real outcomes. And finally, I've just gone, I think it would be fair to say, crypto crazy. So I'm very, very interested in decentralized finance. And typically my work there involves looking at the new protocols and some of the new systems and trying to understand how their adoption and use tells us things about the real world. The real world, as we know, is a creature of history, it's a creature of regulation, but crypto, to some extent, and the decentralized protocols that we see there are very much almost the purest form of the neoclassical model, alive and kicking and spitting out data onto a blockchain. So with that said, I think it's useful to, when discussing money and banking, payment systems, and so forth, is just to think a little bit about what is new and what isn't new. So first, I would point out that private money is certainly not new. And private money runs the gamuts of things like the hyper-local money, like Abeille in Toulouse, or the Bristol pound, which are issued unbacked, and basically they rely on social reputation. They're designed so that people will use that money in the local community, But in Europe, you just see a large range of pretty small scale experiments, but private money, where it's backed by essentially the local community. Two, another form of private money, as Marcus pointed out, is of course the inside money that are issued by banks. And so this is both private and also is not necessarily 100% backed by collateral. So the thing that backs inside money and that makes it valuable is the fact that the regulators and the central government implicitly or explicitly act as a backstop. So people believe that the inside money that's issued by banks is actually backed by something. The third thing that I would point out is stable coins, which we've seen a massive number of them in the crypto sphere, are essentially an old expression of what we've been doing in finance for a long time, which is securitization. You take a fundamentally risky asset, you tranche it, and you provide the safest tranche and describe it as being either AAA if you're doing it in an investment context, or money if you're doing it in the stable coin context. So these are phenomena that we know and we understand. The other thing that is not new is programmable money. If you think about things like in the US EBT, what is that? That is programmable money. It's money that's only available or should only be used for one particular type of purchase. It is not obviously smart contract enabled. It's basically the federal government has been doing it for eons, but nonetheless, it is restricted use money. Also in Japan, we see a huge amount of restricted use money. So the e-money, the railway money, and all these sort of other different ways of paying that are restricted use and also private. So, but they're both public and private options of these. The other thing that I would point out is that the use of tokens to represent money is also not new. Not digitized tokens, but certainly a dollar bill is a token. And it's very, very different from an account-based notion of money. But this is also something that's not new. In terms of the questions that I think that we really, really have to grapple with. So there are existing banks, and they may or may not be hurt by being disintermediated if we go with the retail central bank digital currency or CBDC. I think what is true, and a lot of my work has sort of danced around this point, and I'm actually working on a project that it specifically makes this point, is that there is a natural synergy between the payment role, which essentially always provides a pool of money. Risk-averse people always want to have that advanced protection for payments. This pool of money, the information that it generates, and the ability to make loans. Whether or not the current banks are disintermediated in some way by the changes that are happening now, I don't think it really matters. The corporate forms or whatever entities that arise in the future that basically are going to be plugged into the payment rails, these are going to be ones that in 5, 10, 20 years look a lot like the existing banks today. So then the question just becomes is how they should be regulated. What kind of backstops, if the central government should or regulators should supply. Another question that I think is important to think about is a lot of the discussion, certainly in the academic literature about CBDC, has focused on retail CBDC. I think the more interesting questions are around wholesale CBDC, which is the interbank payment systems as they exist now and how they could potentially become more efficient. I think wholesale CBDC and retail CBDC are very, very different. And it's sort of the interbank pipes that are going to really shape whether or not this becomes an efficient change. If you think about the DCEP experiments in China, these are essentially, even though it's sort of quoted as retail CBDC, it's all intermediated through the banks. And it's difficult to see a government doing anything else, but I mean, time will tell. The final question, or the final thing that I want to throw out, is why do we need money? Money in and of itself is not useful. Money is only useful for me if I can translate my work today into oranges, apples, bananas, or whatever I want tomorrow. And so I think probably the broader question that we should grapple with is not the sort of small perturbations that we make around the edges of the current financial system, but to think about what is the most efficient way as a society as we move forward to solve that fundamental problem. It may or may not be with tokens. It may or may not be completely digitized. Is the way we want to proceed as a society through some sort of a vehicle like money, or through something that is more account-based, which rests in the person. So those are my comments. Thank you.
Thank you, Christine, and thank you to all three of our panelists. Boy, is that a lot to chew on. It's a little hard to know where to start. So maybe what I'll do is I'll pose 2 or 3 questions. In the first instance to one of our panelists, I'll address a particular panelist, but it would be great if the other 2 would then add their thoughts on the same question, and then I'll go to the Q&A, which is starting to populate itself. Maybe starting at the end, Christine, I had a couple of vaguely connected questions for you. When you described the analogy or the parallel between securitization and tranching on the one hand and stablecoins on the other, was the implication there that stablecoins are not always stable in the same way that the AAA tranche is not always AAA at the end of the day? And the other thing I wanted to ask you, just to shoehorn this in, is I'm confused, and I suspect many people are confused about the connection between new payments technologies on the one hand, and the use of cryptocurrencies, stablecoins on the other. So we observe things going on in the decentralized finance sphere. We observe companies with new payments technologies like Ripple, which transfer funds between banks, but they use cryptocurrencies as kind of a medium or an add-on to that process. I'm a little confused about exactly what the role of cryptocurrencies is in DeFi and in these kind of payments over a private blockchain.
Wow, okay, there's a lot to unpack there. So one, are stablecoins stable? No, if you look at the data, stablecoins fluctuate typically around the peg. There are different types of stablecoins. There's fiat collateralized, they tend to be closer to the peg. There's crypto collateralized, and they're algorithmic stablecoins. Some of those are actually quite far away from a peg, and some of them are actually designed like Ray. They're designed to essentially have a floating peg, so they act more like a currency. That said, there's depending on the type of crypto that you're looking at, and essentially it's correlated with the market cap of the crypto or the stablecoin. Some of them you can pretty much guarantee what you're going to get. And this is why a lot of small and medium enterprises, in particular in Southeast Asia, will invoice in crypto. It's just more efficient, or stable coins. So why the huge use of crypto in DeFi applications or stable coins? Basically, payments is very, very complex, and paying for things is complicated. So in the US, as you know, there's this complex regulatory regime where every single state has its own money license requirement. This means that on-ramps into decentralized finance and for paying things for decentralized protocols, this was actually very, very complicated. And so Tether was sort of the first one. They came up with a solution that was native digital that essentially slightly evaded some of this KYC and AML stuff. So it's the fact that there are these specific rails that are difficult to access unless you go through the banks, and the banks have regulatory restrictions that essentially generated this sort of wave of innovation. The final thing that you mentioned was XRP or Ripple. Their native crypto is XRP. It's interesting to note that a lot of the Ripple products like XRapid and so forth are essentially like an internal information sharing that don't really need XRP. So XRP is to some extent slightly different from Ripple the company and the solutions that Ripple the company is issuing. If you think about any company that has smaller subsidiaries in other countries, they will use an internal communication method. Conceptually, you can just view as that internal communication method as essentially a country-specific cryptocurrency, so or a company-specific cryptocurrency. So to some extent, this is what Ripple is doing. I wouldn't sort of put it in the completely decentralized bucket at all.
Stefan, Marcus.
I can go ahead. So I totally agree what Christine said. So it's Ripple is, in a sense, you can view it as another fragmentation. So you have some other space where you can make payments, which is not dollar-based. It's just its own token. It's not really a fully decentralized platform either. So because there's a consortium deciding, what we write on the blockchain or not. So it's a particular form of blockchain. So and that leads me to what Stefan was mentioning. There's different forms of decentralization of finance. One is, I would call it just Robinhood type, where they just lower the entry fees and you have much lower fees and many more people can participate. So it's just a scale. The low fixed cost allow scaling things up and many more people can participate. And then there's the whole DeFi, which says, I don't have an intermediary like Robinhood. Everything is decentralized totally with smart contracts. So there's no intermediary which has any power of it. In Robinhood, they could still shut down or could do something. So there's still some powerful intermediary in between them. So I would classify these two forms of democratization. With regard to the first question Barry put out is with respect to stable coins. I just want to throw one thought in. Of course, most of the stable coins are linked to the dollar. 90% are linked to the dollar. And there's a question to what extent you want to regulate the stable coins, because you might mislead for investor protection reasons. You might say, we have to regulate them. But once you regulate them, you essentially implicitly extend a guarantee as a government as well. And then this becomes a currency on its own. So you support it. It's a little bit like money market funds. The same thing happened. You have money market funds popping up when Regulation Q and all things didn't allow banks to pay high interest on deposits. And then you have breaking the buck rule, which means that they always have to guarantee $1 back. And now the money market funds use this breaking the buck rule as a marketing tool. Even though it's a regulation, they use it as a marketing tool, saying, oh, look, we have this regulation, so we will always pay back. And if there's, like after Lehman, what happened, that they break the buck, then the government steps in and bails them out. And this might happen with stable coins as well. It just means many people can now issue a lot of stable coins, get a lot of money out of it, and later the government will back them up, regulate them, and also back them up. And that's probably what will happen on the stablecoin front. It's very, very similar, very parallel to the money market fund or even the ETF structure. So there's not so much of a difference there.
Christine reminds me that I should ask shorter questions. So for Stefan, I was provoked by your analysis of the role of the global financial crisis in thinking about and the development of the crypto sphere, crypto market. So would you argue that we wouldn't have gone down this road in the absence of the global financial crisis?
I think something was, needed to shake us out of the kind of assumptions of the Great Moderation, right? The status of money during the Great Moderation, at least for those outside of the kind of financial plumbing system, outside of central banks, just the broader public, even well-informed public, really had been removed from questions of politics. And as long as those presumptions reigned, I think it's very hard to see how you could actually kind of see the appeal for something like Bitcoin. That had to be shattered for these debates to actually become relevant again, for the stakes to become visible, and for alternative visions of the future of money to become contestable again. So I don't know which aspect exactly of the financial crisis was responsible. I think actually it's the combination of the shock of the initial crisis, which kind of shatters the confidence of the Great Moderation. But then just as importantly is actually the bailout part, which reveals precisely the public-private partnership aspect of the financial system, that we're not talking about a kind of purely private realm of money versus a purely state realm, but instead that they are entwined, which becomes undeniable in a crisis, but obviously, as all of you is actually a daily reality, right? But again, it takes the crisis to see that.
Others? If not, Marcus, I thought you were, if not, let me pose a question to you then. I was struck by your discussion of bank run risk in the presence of a CBDC. And could you elaborate for a minute or two? In other words, is the argument that we don't have to worry about this because the central bank has the capacity to act as a lender of last resort in unlimited amounts in its own currency, so it will intervene? Do you take the argument a step further in that bank run risk will not increase if there is a CBDC because depositors will realize this capacity exists?
So I would argue that CBDC would be another safe haven people can run into. So if there's a crisis on a single bank, we can always run into a very solid bank. So there is already a bank run. So the bank run risk is not higher when people can run into the central bank than running into another good, solid, sound bank. So the only advantage is that if you run into the central bank sees it right away and can channel the funds back. So it actually, and people knowing that the central bank has a good policy of lender of last resort makes actually bank runs less likely. That's for the case when there is a run on a single bank and there's a solid bank there. Let's suppose there's a whole run on the whole system. And when that's the case, what people do is they run out of the system, they run probably into a different currency. And then they destabilize the whole system. But even in that case, it's actually better for the currency area or the US or Euro or whatever the currency area is, that they run into their own central bank. The central bank sees what's going on and then can channel back the funds. And so, of course, what it requires is that the central bank has a very solid lender of last resort policy. It can differentiate between insolvent and solvent banks, so there has to be some policy. But in general, we extend these guarantees anyway through deposit insurance. So it's just a different way of extending it. So I think it's not a big regime change. You might say in Europe, it might be a bigger regime change because through this channel, you get essentially some deposit insurance scheme playing in the background. But I don't think it's a radical change. And the fear is always, if we introduce CBDC, we will have all these bank runs. This just says you need the right lender of last resort policy in order to stop that. And I think that's the other thing. And I should perhaps, I've done recently, perhaps Barry would be interested in that, written a paper on the 1931 crisis in Germany, where there was a huge banking crisis, 1931. And what you see, the guys who run on the banks, they have no clue. I mean, there are more than 100 banks and 25 banks went down. If you ask them which bank they run on and which banks go down, the depositors, they run without any knowledge. But if you ask the interbank market, which banks, don't lose access to the interbank, it's a very good predictor which banks are going down. Even though the interbank market is tiny compared to total deposit funding, the banks know across each other. So the professional guys know, they can discipline banks. But regular depositors, there's no disciplining role in terms of having a bank run in this sense. So in this sense, it makes sense that the central bank takes a bigger role and also then decides which bank needs to be restructured, which banks can be funded, continued funding. Of course, I noticed that there is, of course, more power than with the central bank. And that's a political challenge central banks have to deal with.
Others? Okay. There's some interesting questions in the Q&A, and I'm going to start with the more straightforward ones, starting with Donovan Rice, who contrasts the role of public blockchains, obfuscated blockchains, private blockchains. One can imagine cryptocurrencies running on no blockchain at all. How important do you think blockchain is going to be in this sphere? Is it going to be the dominant technology for cryptocurrencies going forward? Will it be equally important for stablecoins and CBDCs?
I can jump in. Should I go? But I just
sure. That was to everyone.
So blockchain is like this fashionable term, and everybody wants to call it blockchain, even if it might not be a blockchain. So that's often it's just a database. But the question is, what type of blockchains? Will it be proof of work, proof of stake? Will it be permissionless? And so you have to go into the details, what type of blockchains. If you ask me, will it be proof of work blockchains like Bitcoin? I don't see them surviving. So I can see Bitcoin surviving as a core system, like the reserve system, because you can't scale up the number of payments the same we have on Visa and MasterCard. So the scalability is not there. So proof of work blockchains and have huge electricity waste, huge of pollution and all this will not be the future. Will it be more some proof of stake? So Ethereum tries very hard to figure out how to do that. So far, they haven't figured this out, how to do it so if there is a breakthrough, technological breakthrough in the crypto technology, but then the proof of stake might be the way to go, or it might be more like what Ripple does. You have a consortium deciding, how to update the ledger or not. But all of them you can view as blockchains. I think blockchains will stay, and it would be much more pervasive across the universe. Not just of a currency, but for tokens, we will tokenize everything. Essentially, assign a token to it, and the token moves around as the widgets move around. But what type of blockchain is very important to differentiate. And that's, I think, what the questioner was also indicating, that blockchain is not equal blockchain.
I don't have anything to add on the wager of what the future of blockchain will look like. But just to kind of underscore one point that Marcus mentioned, which I think is exactly right, the purest forms of blockchain, those precisely, that kind of got the whole thing going, that kind of fueled the language imagination, they are just hampered precisely by the features that are increasingly turning out to be bugs, like the energy intensity. And so as we move into other forms of blockchain, it actually, I think, increases the stakes of some of the political questions I raised, because you're then no longer obviously in the world of fully decentralized or just pure cryptology. Instead, the question, for example, the democratic question in a proof of stake model was like, why should the stakes that someone holds from a political democratic perspective matter? Actually is like a fundamental part of how the blockchain operates, rather than just a kind of cute political theory point. So in some way, as the pure forms recede, the political questions become more tricky and more central.
Yeah, if I could just throw in my 2 cents. So the founder of, or one of the originators of the Ethereum blockchain, Vitalik Buterin, basically sort of posed the trilemma that you can't at the same time have secure, decentralized, scalable blockchains. It's just, they're sort of incompatible. That said, there are a lot of quasi-decentralized. So for example, Binance has their Binance Smart Chain, which uses validators who are essentially sort of corporate friends of Binance, and they have tremendous throughput. In the computer science arena, the issues of scalability, side chains, and all this sort of other stuff is right at the top of the research agenda. So they're trying to think about ways to fully decentralize or have decentralized solutions that are more scalable. The last thing that I would just talk about or just point out with the energy. I mean, so in the popular press, the proof of work is described as being extremely energy inefficient, and it does use a lot of energy, absolutely. But then so does Goldman Sachs. And so the question is, what is the appropriate benchmark for something that will fuel the financial system? How much energy do you expect that to use? And the Cambridge, they have this energy consumption index. They have sort of a very interesting website, actually, where they compare different industrial uses and how much energy they use compared to the Bitcoin blockchain, which is proof of work. So I think that's a very, very interesting question, but I haven't seen the specific benchmark that I should take into account on energy.
Just to add to Christine, I think Bitcoin uses as much energy as the Netherlands now from this website.
Apparently, all the plugged in but unused American electronic devices in the home could power the Bitcoin network for 1.5 years. So the question is, what is big? Yeah. I'm sure the Netherlands is important. Sorry if you're...
I need to turn my cell phone off at night, clearly. Let me combine a couple of questions and ask Marcus and Stefan and Christine to respond in order if they so wish. The first one comes from Sebastian, and it asks about central bank digital currencies. What do you think the principal motivations are? Do you think they will happen? And if so, how long will it take for the major central banks to actually roll out pilot projects and then full-scale CBDCs? And I think Vinit's question to pose to Christine is an elaboration on the preceding. Do you foresee account-based retail CBDCs? Do you foresee wholesale? Do you foresee wallets? Do you foresee accounts at the central bank? What do you think is most likely?
So I start with the motivation, I think, for CBDC. So what's interesting, the CBDC debate really took, or the regulators took the whole thing only seriously when Libra came from Facebook. Bitcoin itself was sleeping and no regulator cared about Bitcoin. When Libra came from Facebook or Meta, now Diem, now I think they're selling off Diem and they killed it essentially, the project, that really woke up the regulatory community. And why? Because Facebook had this huge social network of 3 billion users, and they can immediately roll it out at big scale. And what it is really, it's about monetary sovereignty. Who is losing monetary sovereignty most likely? And that were small emerging economies. And that's why you see it came in Cambodia, the sand dollar in Caribbean. So it came in small emerging economies. They moved fastest on some CBDC structure. Of course, there's also Sweden, but it's the countries which are most likely to lose the unit of account role and hence the power of monetary policy to stimulate or slow down the economy. That was essentially the key, which was the key driver, key motivation. So on a defensive measure, so this digital dollarization, so typically the dollar takes over, moves in the country and everything is done in dollars and you have no power of monetary policy anymore. Here's like the Libra would take over. And these countries were shocked and were the first to put up defense lines, which would be, we also want to provide something which is equally convenient on the digital space as the Libra would be. And so the second thing is, of course, that's a defensive measure. You can also go on the offensive. On the offensive, you can say, oh, that's one way to internationalize the renminbi, just to bring it up across. So we provide it in a national way. And so that's why certain countries move to a much more digital currency in order to international. So I'm not arguing that China did that. So China, I think, was much more to crank down on Alipay and WeChat Pay to get the foothold in there and make sure that they can observe. So we didn't talk about privacy, which is, I think, is a very important issue we should probably touch upon at some point. And that's the Chinese motivation, and also probably spread out then across other countries. But they probably would have done better if they would have let Alipay and WeChat Pay internationalize and then only take over later on once it's established internationally. And then there's other countries like there's the Euro area, which, they are also concerned about their sovereignty. Let's say there's a not so favorable president elected in the United States. They're very concerned about that. So they don't want to have the payment system driven by somebody which is outside. You can shut down the payment system. That's a security risk. There's some geopolitical aspects to it. And then there's the US, who is the least favorable towards CBDC, because there's the least urgency from the US perspective to develop this. And there's more a tendency to let the private sector run with stable coins, let the system develop and perhaps intervene later on. But it's typically the case that the US is less interventionistic. They'll let the private sector evolve. And then the private sector is powerful enough and has enough lobbying power to block essentially for having more standardized approach going on. That might be superior for the US anyway, because most of the stable coins are done in the US dollar. So this way it strengthened the US dollar's role. So that's how I would classify what the principal motivation of CBDC is.
Stefan?
Yeah, maybe just to add to that list, which is fantastic. I think there is also an ideological component to it, which kind of ties into this overall struggle over kind of digital products, blockchain, that you want to be seen as kind of contributing, being on eye level with these developments, not just simply letting this drift apart, but actually being able to develop competing projects. And that, I think, can take very different stances. It can mean that you actually embrace the idea of competition, and in some way this is going to be another aspect to a competitive landscape, or it can be that actually we need to reimpose the overweening force of sovereign money in a context that has become too rife with private competition. But I think there is a kind of ideological component, political component to it. There's also, and that might be more relevant to the US debate, not within the Fed, but kind of among Fed watchers. I think there's a kind of parallel debate about Fed accounts that's going on, where it's not just simply about the protection of monetary sovereignty, not just about the international standing of the dollar or digital money, but where there's also a debate internally going on about how could we kind of redesign the public-private partnership model domestically? How can we maybe actually put banks also in a more competitive position as having to offer products that may compete against domestic financial products offered by the central bank in the form of Fed accounts, partially with regard to stimulus payments also, but also partially with regard to problems of financial inclusion, racial wealth gap, and so on. Like, can you use this brute force rather than hoping that regulation will at some point do the job?
Yes, so let me sort of veer in the direction of account-based versus token-based payment systems. So we talked, all of us sort of touched on this idea of inside money, that part of the money supply is in fact created by banks. And they do that essentially by making loans, or that's sort of one way of thinking about it. Now, when you make loans, knowing the person to whom you're making a loan is obviously a very good idea, and you're less likely to face any sort of default. And so there's this natural tendency for persons who are in the payment system and generating money to have a sense of who they're generating that money for. As a concrete example, buy now, pay later, point of sale credit is the largest growing or the fastest growing consumer credit option. So, and the reason it is because new machine learning and other technologies have arisen that allow people to figure out that if you're buying, avocados as opposed to handbags, your credit risk is going to be different. And so there are people that is now being used to sort of generate new generate debt essentially. So I think that having something that is purely token based loses a lot of that information. And I think that information is so valuable that at some point we're going to see a hybrid that is partially account based. And this goes back to sort of one of the questions that I posed, which is, why do we have money in a payment system? We have money in a payment system because I'm doing something today and I'd like to translate that into consumption in the future. And money is one way of doing it, but it might not be the most efficient way. And I think we haven't quite seen where we're going to end up. And I suspect, as with most things in life, the truth is in the middle. We'll end up as some sort of hybrid between tokenized and account-based payment systems.
Very good. So Manuel Sabin has a question addressed in the first instance to Stefan about whether crypto is going to be a progressive or a conservative force. In other words, he departs from the observation that computerizing commercial bank accounts allowed commercial banks to keep up with the expanding demand for financial services, and in that sense slow the development of alternative mechanisms for intermediation and payments. Couldn't we see the same thing happening with crypto, especially insofar as banks are partnering with crypto firms to try to bring the technology in-house?
Yeah, this goes, I think, to the first kind of myth that I mentioned at the outset that I really didn't go into, namely the idea that we're dealing here with something that's just driven by the technology, and that the technology itself has certain political, social kind of implications hardwired into it. That doesn't seem obvious to me. It seems that the technology actually can be used for very different projects, depending on what exactly you put in there in the first place. It's like the basic problem of algorithms. It just reflects what you code into it. So I would be hesitant to kind of associate a technology straightforwardly with any kind of inevitable political direction. Instead, and this is kind of basic STS, we would have to look at, okay, what are the power structures in which this technology is being applied and further developed? And there's every reason to believe that there are, structures of power in place right now that are going to be very successful at molding these technologies in a way that suits them. And I guess that is more the kind of conservative direction, more the direction of maintaining the status quo. Now, to put that into a bigger frame, including some of the terms that Marcus helpfully introduced, it's very tempting whenever we look at these new developments, also new ideas, to kind of envisage entirely different monetary system, right? Be it the Vollgeld, the kind of pure public money, or be it a Hayekian full displacement of public money by private money. And instead, what we've seen over and over again is that there seems to be something about money and banking under capitalism that has this hybrid quality built in, this public-private partnership nature, that you probably need both of these elements, and all these innovations, once they actually develop in an actual structure, tend to exhibit both of these sides. So that means, on the one hand, that crypto blockchain projects, like, for example, the stablecoin discussion that we had a moment ago, will actually kind of gravitate towards the PPP model, because maybe they get regulated, but that also means they kind of get implicit bailout guarantees, they kind of come under protection, and suddenly something that started out as a completely radical challenge of the system, whether you think of it as a progressive challenge or a libertarian challenge, is beside the point, but something that starts out as a challenge actually ends up looking very much like just another facet of the current banking system, right? Something that has some relationship to the central bank and nonetheless also some private component. That's basically what we already have. I think there's a bet that even central bank digital currencies, they still need kind of customers, they still need to have a demand. And so even they are not pure kind of sovereign money, but they will also be successful only if they actually are private market for these CBDCs. And so in the end, you end up again with the hybrid system, which is, I guess, the status quo.
Christine, Marcus?
If I could just sort of reiterate what Stefan said. I mean, if we think about the DCEP in China, it's being intermediated by the banks. So that seems to be sort of the natural steps that people take.
Yeah, let me just add to this. So I don't see central banks giving everybody an account and being innovative and user-friendly as the private sector would be. I think the innovation will come from the private sector. And it's always, if you look at the history of money, there's innovation in the private sector, then the government sector tries to grab something back. But that's a healthy, arrangement that you have some interaction between the public and the private sector. And the way I see Libra is a little bit similar. If I look at the music industry, there was always, probably you're all old enough to remember, there was Napster. Nobody remembers Napster these days, but they essentially revolutionized the music industry, how we listen to music. And Bitcoin might be similar, or Libra is probably already similar, it's already there, but it triggers something, it's a catalyst to a new environment. And I'm optimistic that the new environment will be way more efficient, and but it will have hiccups. So we have to learn over time, but we will go to a new era, and that makes it exciting. And many of the new elements in the new era is, goes back to the free banking era. We can learn from the free banking era. So there's something in history we can bring to bear there, but it will change. So I'm pretty sure we will not go back to the system before we had that.
We have about 5 minutes left, and I'm going to try to shoehorn 2 questions with the panelists' cooperation into that time. The first one shifts back to private label cryptocurrencies. It comes from Vikas Mecca, and it's about the question of concentration versus decentralization. Don't we see an awful lot of concentration of holdings and ability to move the market, not only in consolidated powers in crypto exchanges, but more broadly that a small handful of players are responsible for a large share of overall transactions? Is this a passing phase in the development of a larger decentralized market, or is this a tendency, a trend we should worry about?
I'll just jump in very briefly. So I think in most of the DeFi systems, yes, you're going to have people who are sitting on a whole bunch of coins. Miners hold a tremendous amount of power. They hold tremendous amount of power pretty much on any blockchain. And I think, a lot of the decentralized finance systems are based on the idea of the profit motive, and there is a natural tendency towards monopoly. We don't actually get to monopoly because nobody wants to devalue the coins to the extent that they're obviously controlled by one central entity. But certainly there's a tremendous amount of market power, and I would argue that a lot of these systems act like oligopolies.
I very much agree with Christine. All the mining pools, so there's a huge concentration of power on paper. They all look very competitive. In the real world, they don't. And that's because money is a network. There's a lot of network effects. There are all these network effects which lead naturally to more natural monopolies. Of course, as Christine pointed out, if it's only a single monopoly, they might behave differently too. So it might be a problem as well. But the forces are very strong for concentration. That's another argument that the state should not be excluded.
Final question then comes from Tamaro Teresiano. Tamaro has the feeling that cryptocurrencies, the market in cryptocurrencies has been stimulated, has been driven by the low interest rates of the last decade. And he wonders whether the market is going to be set back now that we're moving to a higher interest rate environment. And I would add my own related concern. There have been some statements in the last couple of days by people who run crypto exchanges saying that they don't discriminate between customers in different countries. And if people in Russia want to use their cryptocurrency to move money, they have no control over that. Are recent geopolitical events going to affect the future of the market? Stefan, maybe I'll point to you first.
Maybe just kind of straightforwardly take the question and then kind of speculate a little bit from then on. I think there are 2 elements to the way in which low interest rates have fed into it. One is, first of all, the idea, and I think that was more pronounced in Europe, of the kind of cheap money central bank monetary policy as kind of fueling some of the kind of, almost conspiratorial frustrations that also came out of the financial crisis. Namely, the idea is like, this is just a continuous proof that there is this actor in the system that is able to generate money, right? All of us have to earn money, but somehow central bankers seem to be able to just like print money. And that came out in the bailouts, obviously, most pointedly, but I think it continued as a rhetorical trope, in particular on the right, the kind of libertarian conservative audience, like way longer through the phase of low interest rate policy, kind of cheap money policy. And so the political attraction of Bitcoin as a system that doesn't allow for that discretion is, I think, actually tied to this. The second point is that obviously the speculative asset side has something to do with just like a lot of money chasing returns. People are just looking for anything that they can invest in. And crypto seems like a peculiar kind of asset that seems interesting to mess around with in this context of very low interest rates.
Marcus.
Yeah, about the low interest rate, I think it definitely contributed to it. So it's a financial crisis and the low interest rate. But I'm not arguing, it's not clear that you should look at the nominal interest rate or the real interest rate. And if you look at the real interest rate, it's extremely low at the moment. And if you look at the communications of the central banks, they're not moving one-to-one with the inflation, the interest rate up. There's no Taylor principle, anybody pronouncing, saying we have to move more than one-to-one. So on the one hand, you are worried about inflation, but inflation will make actually these cryptocurrencies more attractive. Even if the interest rate, the nominal interest rate goes up a little bit, but if it doesn't go up more than the inflation numbers, then I don't think there's a big threat there. The other thing is with regard, the second question with regard to Russia and the sanctions on Russia. What was very telling, if you just look at the last few days, how gold and Bitcoin moved around. And initially, you saw a flight to safety into gold and not into Bitcoin when the sanctions were announced. But then it was announced that actually the Central Bank of Russia cannot sell its gold because nobody will clear it. But Bitcoin is still moving. So you saw yesterday, you saw a huge increase in the Bitcoin price. And that's all because now the only escape from the sanctions is through Bitcoin and not through gold anymore. And suddenly Bitcoin becomes much more attractive. And that's why you see this increase in the Bitcoin price. At least some argue that was the last few days you saw the increase in the Bitcoin. People realizing that that's the only escape for Russian investors or the Russian officials to escape the sanctions.
Christine, you want a last word?
Oh, as a finance person, I don't feel comfortable saying which way prices are going to go. But I do feel comfortable saying cryptocurrency is here to stay.
And that's a fitting note on which to end, I think. Let me thank the panelists, apologize to those who put questions in the Q&A that I couldn't get to. Thank Marion, and Pierre-Olivier and company. Encourage those of you who've discovered the social science matrix for the first time to come back to future meetings. So again, especially to the panelists, thank you for your contributions.
Thank you, Barry, Mariam, everybody.
Bye now.
Thank you, Barry, for moderating.
Bye-bye.
Thank you. That was wonderful. Truly.
Bye-bye.
Very grateful.